Hello, there are only going to be, 3 lectures in this unit on policy, so I'll try to keep it as brief as I can. So we'll start with economic policy. And economic policy is controversial because the question that you see mostly between Democrats and Republicans in Congress is, and even within the presidencies, is how much should the government be involved, or how should they be involved? Economics is the social science that studies the production, the distribution, and the consumption of goods and services in a marketplace. And historically speaking, it hasn't been that intertwined at a policy level with the U.S. government. But they have increasingly become more and more linked together. One of the trends that we've seen in the 20th century is economic conditions. They tend to be the best indicator of a voter's evaluation of a president, i.e., people tend to look more favorably upon presidents who serve under good economic conditions, right? So Bill Clinton is remembered for being a good president. We had a surplus under him. Franklin Roosevelt. Presidents that tend to be viewed more negatively because of economic crisis usually include people like Jimmy Carter. Sorry. I'm losing my voice. There are some exceptions to this, though. Almost half of the public evaluated Barack Obama negatively as a president during his presidency at different times, even though the economy was recovering. So it's not always true, but for the most part, it is true. So the basis of economic policy is capitalism here. Or at least that's what we like to tell ourselves. Adam Smith is the father of capitalism. He wrote a book called The Wealth of Nations. There's the cover. In 1776, which was a very important year for us. And in it he defined capitalism and wrote about the free market and laissez-faire, which is French, and it loosely translates to something like let the markets be, or let it be. Hands off. The idea is the government shouldn't be in the business of regulating business that much. Now, if you actually read The Wealth of Nations, it's a lot more detailed than that, but that's the takeaway that most people tend to remember about it. But Adam Smith does talk extensively about government and the role that it does play in the economy and the things that it should work to do. A mixed economy is really what we have, even though I think we like to say that we have a capitalist economy. A mixed economy is an economy in which it's mostly capitalistic, but there are some things that are run or controlled by the government, like police, fire departments, schools. Another term for a mixed economy is socialism. But don't tell anyone that, because it's very controversial. We don't want anyone to think that we're communists, even though technically there are no countries in the world that are a straight up capitalism, and I want to say there's no country in the world that's straight up communism. Most are mixed in some way. So capitalism, it's a free enterprise economic system in which the means of production are privately owned. People who own the means of production and capital are free to invest that capital into other businesses in the private sector. Prices, production, distribution, they're all determined by the free market. Demand dictates price. And it tends to be associated with, like, deregulation. Our capitalism has gone through periods more or less of regulation. Again, we're not a purely capitalist society. We're more mixed because the government does play a role directly in our economy. They do own certain businesses, and there's such thing as corporations that are run by the government, like the Postal Service. But they also regulate private businesses because, you kind of have to. So a lot of the regulation of businesses started obviously in the Gilded Age, when there was a lot of abuse of workers' rights and things like that going on. Unemployment is something that relates to social issues, and it's something that the government tracks and that they try to create policy to help counteract. The unemployment rate is measured by the Bureau of Labor Statistics, which is a government bureaucracy, or bureaucratic department. And it looks at the proportion of the labor force that is actively seeking work but unable to find jobs. So it doesn't take into account, again, people that are underemployed or people that have stopped looking for jobs. Inflation is the rise in prices for consumer goods, and that's that is analyzed by looking at the Consumer Price Index, or the CPI, which is a group of economists that measure inflation over time in specific goods. So they'll look at the average price of bread or the average price of a gallon of gasoline and measure how it changes over time and take an average of that to figure out what the CPI is, which is, again, just the measure of inflation. Democrats tend to be more into government involvement in the economy, fixing employment first, and then inflation. That tends to be the priority of Democrats. Republicans tend to be less government involvement types in the economy, and when they do get involved, they want to fix the inflation first and then focus on unemployment, which is one of the reasons why Democrats tend to fare better in presidential elections when there is a financial crisis, because they're the ones that are like, we will fix unemployment. And I mean, Republicans will too, but like, they're arguing more, complex economic arguments that I think might be a little lofty. All right, so there was a recession. You probably remember it, in 2008. Low interest rates fueled the housing market, which means lots and lots of people started buying houses that they couldn't necessarily afford because the interest rates on the loans were so low, which led to this housing boom. The number of subprime mortgages increased. That just means that banks were selling mortgages to people that they knew couldn't afford them in the long run, with the intent of just taking the property back from the person after they defaulted on their loan, because either way the bank has made money off of them up until the point that they stop paying their mortgage, and then they can flip the house and sell it to someone else. It's real nice. And eventually a high number of homes for sale caused deflation and a lot of foreclosures and things like that. One of the reasons for this was that in the 90s, Congress deregulated the banks. They took away a specific provision that had been put in by the New Deal to ensure that banks didn't do this kind of predatory mortgage stuff. So there was a collapse of banks, and the threat of the collapse of the largest insurance company and some of the largest banks and auto industries in the United States. And had those things collapsed, it would have caused calamity for the economy that we'd still probably be digging ourselves out of, and I think the government realized that. So Bush started the bailout programs. They were proposed by his Treasury Secretary and signed into law in 2008 at the end of his term, and they mostly went towards banks, Freddie Mac and Fannie Mae, which are two very large loaning institutions. And so they just give them a lot of money to help them dig themselves out of bankruptcy, basically. And there is, you can Google the bank bailouts by the numbers and see, which businesses got what money and analyze that if you want to. There's a link here if you want to look at that. But it was a lot of money that was given out under the Bush administration. And then there's the TARP, which was also done under Bush. It's the Troubled Asset Relief Program, in which the government purchased loans from banks. So loans that banks had given to people the government took on, so that banks were no longer at risk of losing money from foreclosures from them. And then Obama got elected and pushed through a stimulus package, which is part of Keynesian economics, in 2009, which was a federal expenditure on social service programs and infrastructure. And also there was an auto industry bailout, like Chrysler and Ford got a lot of bailout money. A lot of money went to things like student loans. A lot of money went to people looking for work. A lot of government jobs were created. And they started doing road and bridge repair projects because that puts people to work. All right, so monetary and fiscal policy we've talked a little bit about in class. They're similar types of policy, but a little bit different. Monetary policy, again, deals with the money supply and interest rates, and monetary policy is mostly dictated by the Federal Reserve, the bank of the banks. And they can raise interest rates, they can set the Federal Reserve rate, all of the stuff we've gone over in class. Monetarism is the idea that the money supply should be controlled to maintain price stability in a healthy economy. One of the things that the Federal Reserve does is that it controls how much money is actively in our economy, because doing that controls inflation. the less money you have in circulation, the less inflation you have. The more money you have in circulation, the more inflation you have. So they monitor where inflation is and where they think it should be for a healthy economy and pump money into the economy accordingly or take it out. Most of our money is digital anyway, so they can do that really easily. Fiscal policy deals with the budget and other fiscal issues like the government setting the minimum wage, which has been really controversial in the past 2 years. And the president and Congress, but mostly Congress, control fiscal policy. The president, of course, can suggest things and they can support it and sign it into law. But Congress is really the wheels that turn fiscal policy. So we talked about Hayek, the Hayek theory of economics. It's just not very popular in the U.S. Keynesian is much more popular, and politicians that stick to Keynesian economic theory tend to be more likely to get elected because people view their politicians as actively doing things to help them get out of a recession or depression. So this theory is that government should be actively involved in the economy. They should use fiscal and monetary policy to manage the economy. So you can be expansionary, you can increase spending or cut taxes to create demand in the economy, right? Because giving people tax cuts means they have more money to spend. Or you can be contractionary, which is where you decrease demand by cutting spending and increasing taxes. We're not going to talk about Hayek because, again, politicians that tend to support the Hayek theory, they have a hard time getting elected because the Hayek theory is don't do anything. And that's hard when people vote based on the economy. So the theory that Republicans really stick with is the supply-side economic theory, which comes from Ronald Reagan. He called it trickle-down. And Trump has a similar policy, which the media is calling trumped-up trickle-down. Super fascinating. You should look into it. So the idea here is that you reduce taxes and government regulation, and then businesses have more money to pay people. Therefore, people will work harder, and it will create a greater supply of goods, and that the wealth that you give to the businesses and the people at the higher echelons of society through tax cuts and things like that, because they are the job creators, et cetera, that money will trickle down to the lower classes. Now, we haven't really seen a lot of evidence of that. In fact, we've seen more income disparity since the 80s, but it is one of those things. So another thing that makes it difficult to control the economy is the rise of the global economy. The World Trade Organization is an international organization that regulates international trade, or at least tries to as best as it can. So they're trying to ensure fair trade practices. Meanwhile, protectionism is an increasingly popular political economic tool in which countries are trying to shield their economies from imports, right? So when Donald Trump talks about building the Dakota Access Pipeline, he said that he wanted it to be built with American-made goods, which is hard because American steel companies don't make that much steel anymore. Most of our steel comes from overseas. And that one project alone isn't going to create demand for steel from the United States, plus it's just cheaper to get from other places. Outsourcing is one of the byproducts of globalism. And so, he may want to build the wall with American goods, but it's going to be real hard to do that. And also the private sector is becoming harder to regulate because it's been deregulated so much since the 80s. So the types of economic policy, there are business, consumer, and labor policies. Business policies usually have to do with subsidies, loans, product research, antitrust laws fall into that category. Then there's consumer policies, which increase regulation over product safety and advertising. The FTC and the FDA are part of that. Then there's the labor issues, where you see a struggle between business and labor, so the government gets involved in collective bargaining, unemployment compensation, minimum wage, safety standards, 40-hour work weeks, etc., etc. So this is your last flipped assignment. If you'll read this attached article and answer this question, I think that's all that I have for you today.